And so they're already starting to look at this market as interest rates start to come up as being expensive. And that's what it's starting. They're starting to change their approach with people and suggesting, okay, now you can start thinking about going to bonds, right? We're gonna change we're gonna adjust. So people are going from many people have 100% allocation to stocks because bonds were paying nothing, and now it's going to start shifting. So kind of a major impact on the market as we set kind of a threefold impact. First, you have recession, which reduces the consumer spending, right? People on the margin start to get less money. And so less spending means these companies are making less money profits, which means their earnings go down, not up. Their growth rate goes down, not up. And their PE ratio goes down. And so all of a sudden, something worth $100 is now worth $80. So you have that. Then you have interest rates rising, which we just talked about, which changes the discount rate. So now that $80 thing is actually worth $60 because of the change in risk capital. And then you have the impact of the spending that's going on or not going on out there as they start to reduce the amount of capital available in order to control inflation. So now the government is going to be more restricted in its spending. The Federal Reserve spending. Yeah, this is monetary policy, and so the Fed is raising interest rates, which pushes interest rates higher. They're cutting back on spending in order to stop the inflation levels that have occurred primarily because Biden's administration put $4 trillion into the market. And the only way the government could get that money to spend was to simply have the Federal Reserve print it and buy treasury bills with that printed money. And then that gives the government the money to spend on the $4 trillion. So they're having to cut back on that as much as they can. And all of this is creating a scenario that says the stock market is done going up, and it's probably done going up for a long time, as in potentially for a decade, 5 years, 10 years. Nobody knows for sure.
Right now is one of the best times I've ever seen for somebody to start learning rule number one. If you think about what's going on right now in the market, we have this high inflation rate, and it's forcing the Fed to take action. This may be a bit of a cynical view, but if you think about what the Fed's doing, is they're effectively using monetary policy to push us into an economic recession. Now, if you think about how that manifests itself in the market, it's bringing market prices down. And this is a great event for us. It's an absolutely wonderful event for us because we have wonderful companies in the market we've been tracking for many years, waiting for them to go on sale. And normally we're waiting for an event that impacts a specific company. And this is an event that's impacting all companies, but is there anything wrong with the company? No. We simply have an economic downturn, a natural business cycle that's occurring. And now we're looking at the possibility of having some of the best companies in the world being presented to us at our margin of safety price. I can't think of a better time, certainly not since I started, to begin learning rule number one, investing.
Price versus value. Instead of a hyped up value based on stupidly low interest rates and a market that has nowhere else to put the money because bonds are paying zero, you have prices that have gotten out of control. You can't look at those out of control prices where the Wilshire to GDP ratio is 250%, when historically it's pricey at 120. Yeah. You can't look at that and say, oh, it's the new normal. It's not nothing normal about what's been going on the last 15 years. Nothing normal about it at all. Yeah. So if I'm right, then what that means is there's a great resetting of what normal looks like. And when that happens, there's going to be a shock to people who have never seen the market really go down before. And they're going to get crushed. What I'm hoping for you guys who are listening is that you're paying attention to the value of the business, not to market timing at all. I still own a number of stocks because they're still cheap and I want to buy more if they go down, but they're not anywhere near intrinsic value, so I'm not going to sell them. So it's not timing the market, it's looking at value and saying, all right, I'm not going to play the game of just hoping this just goes up forever. I mean, this thing is expensive. For now, I'm going to sell it. I'm going to take my profit off the table and I'm going to wait patiently and buy the same company back when it's selling for about 60% less than it's selling for right now. Now, I'm not crystal balling it. I'm just saying that these are the normal fluctuations of the market. They happen with great regularity, and they will happen. With great certainty, they're going to happen. The question is whether you're going to have capital available to deploy or not.
One of the most liberating things about rule number one investing is you don't have to time the market. All you have to do is simply follow the method. And when the market brings you a company on sale, all we have to do is execute and buy it. And we don't have to worry about when the market's going to go up, because we know eventually if you picked a wonderful company and you bought it on sale, even if the market continues to descend further, you can either buy more or it's just a matter of waiting. And ultimately, you bought this company at a deep discount and you're going to get a very nice return. And that's really all we have to worry about. We don't have to worry about being a perfect market timer.